Why is it that stock market grows at 8 to 10% per year? That seems unsustainable, but what do you think? Today, I think will just be me and John, and we're just going to talk about some interesting questions that have been on our minds recently. One of the ones that came to my mind is back when we gave that presentation a month or so ago, we had an interesting question from someone, which was, why is it that the stock market grows at 8 to 10% per year? Because we've had 30 years or so, even longer than that, actually, of many, many decades now of 8 to 10% S&P growth. And it is interesting because the US GDP has not grown that fast. It's grown, 2 to 3 to 4%. But the stock market has outpaced that for a long time. And that seems unsustainable. But what do you think?
There's no obvious answer that pops into my head, so maybe we can just talk back and forth and brainstorm a little bit. There are probably a few effects. I think the first is all of these things that track the market are typically indices, right? They're not tracking the entire economy. So the S&P 500 index is supposed to be 500 of the largest companies that represent the US economy. So there are going to be situations where it doesn't capture the entire growth of the entire economy. In instances where companies are in decline and the market cap shrinks over time, they might be replaced by another company that's growing quicker. So there's this self-selection bias towards faster growing companies and larger companies that will compound over time. I think a second potential reason is that if you think about the composition of the S&P 500, if we're just using that as a proxy, there are a lot of international companies there, right? Apple's a very classic example where Apple sells a lot to countries outside of the US. And during the past few decades, they've grown a lot in countries like China. Nowadays, they're growing a lot in countries like India, where the GDP growth exceeds that of the US. And they're able to capture that as sales and revenue growth and earnings growth. So they're levered to international markets, not just the US, and they're able to grow faster than the US economy that way. I think the third, especially in recent years, is just multiple expansion. So the multiple that the companies are trading at have gone up over time. As markets become more efficient, as there's more demand for the stock market and shares, especially recently, I think we've seen multiples actually expand. So that's likely another reason. But I don't know, Nick, what do you think?
Yeah, it's a really tricky question. I do think a big part of it is the reasons you said, especially the international growth one. uh, because if you're Facebook or Nvidia or one of these now large companies, you're benefiting from global GDP growth, but your costs just aren't growing nearly as fast as the international GDP. And if international GDP growth is concentrated among the smaller subset of companies, then that could really amplify the growth rate for these companies. I think companies have become more profitable over time. Wages have not grown nearly as fast as revenue, especially for these large companies. The labor side or wages side is growing, call it 2, 3%, whatever is in line with inflation, maybe higher if you're at some of these faster growing companies. But then a bigger proportion of the total GDP is going over to the capital side. So, say, for example, if you have half of GDP growth going to people who own assets and invest in assets, that might only be the top 5% or potentially even the top 1% of wealth are people who own a majority stake in a lot of these businesses. And if you take 3% GDP growth, give 1.5% of it to the top 5% of wealth, then all of a sudden that potentially is, 15% growth for that group of people. This is speculation here, but I think there's probably something going on with just inequitable distribution of wealth, where you're still seeing growth among the labor population, but a majority of the growth is actually benefiting investors as opposed to the worker.
Yeah, it's an interesting point because as costs go down, even if the revenue is flat, the earnings should go up. And not only do you as shareholders benefit from the earnings growth, but also earnings growth translates into higher multiple, right? So that translates into higher valuations and perhaps is another explanation of why the markets have compounded the way it did.
Yeah. And it's interesting. I do think AI will be pretty beneficial for companies, and it makes me bullish on the market in the medium term, just because it's something that will even further reduce costs. A typical tech company, for example, you spend, 20% on cloud, you spend 15% on marketing. Your biggest cost, besides your cost of goods sold, which is cloud, is always people. And I think for a typical tech company, 15% of your employees are customer support. Realistically, that should go down a lot. You have maybe a third of your employees in R&D, so coders. That should go down by a decent amount, actually, or stay flat. I think there was a stat where it was almost 50% plus of code recently generated in GitLab was by Microsoft's Copilot. Like it's not human
Yep.
generated anymore, which is kind of nuts.
Yeah. This was from
Uh,
mid last year too. Yeah.
yeah,
This was still
yeah.
very early on. Yeah.
That stat's probably gone up. But yeah, I mean, you and I see it among recent college grads, I think, especially, and or current college students, where it's harder and harder to find jobs.
Yeah, it's actually an interesting point you brought up, which is as you see productivity gains from AI, it should put pressure on wages and on workers, and perhaps it's deflationary. But I'm going to offer a different perspective. Let's say you had a computer, a supercomputer that allowed you to do your job 100 times better, right? If that computer were readily available to every single person, what could that company charge for that computer? On one hand, you would argue, well, it's 100xing my productivity, so whatever my productivity gain, I'm willing to pay for that. On the other hand, I view a tool like that as almost similar to any other gain that we've had throughout history, except just compressed into a single period, right? So if you think about computers, memory has gone up, processing power has gone up, but the value that people are willing to pay for computers has remained relatively flat, right? Because costs
Yeah.
to produce those things have also gone down. And I told you, Nick, I said overnight, you got a computer that was 100 times more powerful, and you could draft emails 100 times faster. You could reach out to 100 times more contacts. I'm not necessarily sure you, as the CEO of a company, would fire everyone. You would just say, okay, I'll pay for that tool. I still need people in various functions. Maybe I need fewer people, but maybe I do the math and I'm like, why would I fire everyone if every single worker is 100 times more efficient? Why don't I just keep it and grow my business 100x?
That's the optimistic view of things, but it is how
Yes,
things
it's
have
very
played
optimistic.
out.
Yeah.
It is, no, you're right though, because computers made people a lot more efficient. But basically, what happened is people just found more problems to tackle. Like more, well, in some ways, more problems to tackle, but in other ways, we've just found other ways to occupy our time. So, for
Exactly. Yeah.
example,
Yeah.
yeah, like Facebook as a whole, there's a decent argument that it's a waste of time, right? Like we're basically just having fun, posting about our lives, and it's a company that benefits from both technology, but also people having time to do stuff besides survival. So maybe there will be more companies like that in the future where
A
it's,
hundred percent. Yeah.
yeah, it's just games, for example, or other stuff uh, that us not having to spend more time on work creates.
Yeah, but I mean, I think that's the beauty of it, right? Because if you look at the arc of human history, as people had more time because they're not spending all their time hunting and gathering, they've been able to spend more spare time on the arts and innovation, and over time it's compounded in productivity, right? To your point, I think that's going to be similar here, where new jobs will be created. For example, prompt engineers or people double checking the work of AI. Maybe there's more quality control, right? If you used to have five coders coding a feature, maybe now it's five coders monitoring the creation of new code, making sure there's no errors. Things will always pop up, and obviously it's hard to predict how fast we'll need to adapt and react to that. But certainly, new companies will pop up. It's probably unpredictable which areas they're focused on. But the optimistic scenario is that it'll just be a productivity boost for everyone and everyone will benefit.
Yeah. This just makes me even more bullish gaming companies, which, I'm long, but has not worked out. Because like anything that just sucks time and attention as that becomes more available, I think will do well, but maybe I'm just not even conceiving of what people will spend time on in a post AI world.
Yeah, but even that's a great example. I mean, look at how big of an industry gaming has become, or social media influencer. You brought up Facebook or Meta as an example of a company that effectively capitalizes on people's leisure time. But I mean, these are huge dollar amounts going into the industry, the influencer community, the gaming community. I think new pockets of society will pop up. There will be new winners and losers during any technological revolution, which is why I think it presents so much opportunity from an investing standpoint. But I do think that the optimistic take is not that everybody gets laid off and we all lose our jobs, but hopefully that it's a productivity gain for everyone, and there's new companies that emerge, new winners that emerge. But the net of society is that we're just more productive and we can get more things done in a shorter period of time. That's like the optimistic scenario.
So I also want to talk about the second topic, which I think is an interesting one, which going back to some of the ways the market has evolved and the market has grown, which is the entire separation between the private and the public markets. Do you want to first describe for people like what an accredited investor is and what can an accredited investor do?
I think it's like you have certain amount of income for 2 years. It's like 200K per year for like 2 years, or if you and your spouse have 300K, or if you have $1 million of liquid net worth, something like that.
Yeah, exactly, exactly. It's 200K for a single person,
Yeah.
300K for a couple,
Hmm.
and a million in net worth excluding your primary home. I think it hasn't adjusted for inflation at all. If it did
Yeah, and
adjust for
not at least in
inflation,
the same, yeah, at least not in
yeah,
the past decade, I feel like,
yeah, it would be a
if not
lot
longer.
higher.
Yeah.
Uh, but yeah, it's such an interesting concept. I think I haven't looked too much into the history of it, but I think it was originally created to protect investors. Recently, Congress was thinking about giving more people access, but then there are also some people in Congress who are like, we need to raise the amounts because it hasn't been adjusted for inflation, so it no longer serves the original purpose. So there's both sides. There's people who want to make it harder to be accredited and less hard to be accredited. And the reason this is important is accredited investors can access a lot of different opportunities, right? For example, you and I recently invested in a few AI startups, and one of the questions we were asked is, I just want to check if you're accredited. Actually, one of them did not ask that, which we should, they're probably not financially sophisticated enough. They'd probably be a little worried. But it is interesting because companies are private for longer, and we can see that through these massive companies that have been funded by SoftBank that have just not chosen to IPO. And it creates weird distortions in the public versus private market. I have a few stats that you might find interesting. In 1996, there were 7,300 public US companies. Now there's 4,300, which is kind of bizarre. Like over the past almost 30 years, we've cut in half the number of public companies. Why do you think this is?
It's a good question. So I think, I don't know. If I had to guess, it's partially consolidation. Companies are realizing it's much better, much easier to compete when you're a bigger company. You get bargaining power, you get economies of scale, you get the ability to recognize synergies from both a revenue and a cost standpoint. I think companies are realizing that, right? I think the
Yeah,
second perhaps is when you are private, you don't have to answer to your public shareholders. There's a lot less pressure to manage results for the short term, and you're able to make longer term investments. For example, Facebook stock recently got punished for talking about an investment cycle, right? If you are private, you don't have to deal with that. You don't have to worry about your stock selling off on a capex cycle. And this is not the first time Facebook has done this, right? So I do think there's a certain element of hesitation because once you go public, you face a whole set of other challenges in answering to shareholders and focusing more on the short term versus the long term. So I'm assuming some of that is related to that as well.
yeah. I think that's right. I think definitely the regulatory scrutiny of a public company and the pressure. Like, why would you want to deal with that if you can just stay private? If you can get $1 billion from SoftBank or Tiger or one of these large funds, you may as well just stay private as long as you can, so you don't have to deal with the
It's true.
annoyance of public shareholders.
Yeah, it's true. And I think you bring up an interesting point, right? Which is one of the biggest benefits of being public is access to liquidity, access to capital. But recent innovations have made that a lot easier for private companies, right? Number one, you mentioned there's a lot more capital that's accessible to private companies. That's one. Number two, I think there are innovative ways now to allow employees to liquidate their shares in the secondary market, perhaps borrow money against those shares. So there's a lot less pressure for companies to go public so that their employees can receive liquidity because that historically has been one of the reasons too. So I think there are a bunch of, I'm sure I'm missing a lot of other reasons too, but I think you bring up some really good points of why a company would choose to be private nowadays.
It does feel a little bit unfair in the sense that one, there's fewer public companies, and two, now it's like funds are how you access these investments. Where once upon a time, Amazon, for example, if you bought it when it initially IPO'd to now, it was a really small company. I don't know what was the market cap of Amazon when it
I
originally
don't
went
know.
public.
Yeah.
Let me see.
That's a good point, by the way. I'm curious if you searched up the average market cap of a company that IPOs today versus the average market cap of a company that IPO'd a long time ago.
But yeah, it's interesting. I feel like it's both created some distortions on the private market side, but also changed what access means on the public market side. Have you heard of the Destiny XYZ ETF?
No.
Yeah, it's interesting. It's basically an ETF that owns stakes in Stripe and a lot of the other large private startups. These startups are in the 10 plus billion-dollar range in terms of
Yeah.
valuation, and they're just not coming public now. These guys who, kudos to them for thinking of this idea, basically bought stakes in these startups. They then released it as a close-ended fund with a
Yeah.
$5 NAV, and the price of the ETF at one point hit $80, which is
Wow.
what, 80 on 5? It's 160 times their NAV. The NAV, by the way,
16 times.
sorry, 16 times, yes.
Yeah.
The NAV, net asset value, being the last private valuation of these companies.
Yeah.
So it's pretty unbelievable. At most,
Now,
you
obviously,
probably,
obviously, the value of those private companies would have gone up, right? Because they're marked at at the latest round.
Maybe, or maybe
Regardless,
they've gone down. Maybe they've gone down. It's hard to say.
that's true. That's true. Actually, in this
Yeah.
environment, it's possible they've gone down. Yeah, that's true.
Yeah.
And regardless, it's certainly trading at a premium because if you think about how much the valuation of companies go from round to round, it's certainly on average much less than 16 times, right? If you think about it.
Yeah. It's
Like a company
absolutely
going from
nuts.
Series A to B. Yeah.
Yeah. I mean, admittedly, the stock has fallen from 80 to 13 or something like that. So there was clearly some
Yeah. Yeah.
weird mania around this. But even 13 being at more than twice the last valuation is it's pretty, these are big companies. You're talking about
Yeah. Yeah.
doubling Stripe. Like that's a big valuation.
That is
Uh,
really interesting. Yeah.
yeah. It shows like there's some hidden demand for accessing these private investments. Accreditation rules just seem a little bit silly to me at this point.
I agree, especially with the proliferation of Robinhood and Coinbase and the ability for a lot of retail investors investing in exotic things like options. Certainly if people wanted to chase risky assets, they could already do so, right? So
Yeah.
I feel like loosening the rules, again, makes a lot of sense in my mind.
Yeah. It just seems like something that where you only give access to some of the better investments to just wealthy people, which seems fundamentally kind of unfair.
Yeah, I agree.
Yeah. All right, nice. Anything else for us to talk about today?
No, I think we can pick it up next time.
Thanks for listening in. I'm Nick, and I've worked in finance for almost a decade. If you enjoyed this video, please give it a like and follow our channel for future videos. You can check out our WeChat group for more wealth and retirement tips. Talk to you next time. Bye.